Good afternoon, everybody. Today I'm chatting with Thomas George from Grizzle. If you are on FinTwit, you've probably seen Thomas. He's got a pretty big following and he covers everything from cannabis to uranium to big tech to anything that's relevant in the Canadian junior markets. Of course, anybody following this channel knows that I love the junior markets, especially here in Canada, and they've been going through a bit of a rout, so we get into that with Thomas. We also discuss Thomas's ETF, D.A.R.P, Disruption at a Reasonable Price. The ETF has seen inflows pick up pretty bigly over the last year, and they've also been outperforming the S&P 500 over that time period. I really enjoyed sitting down with Thomas. We've been friends for years, and I hope you guys enjoy this interview as much as I did sitting down with Thomas. All right, everybody, enjoy the interview. Thomas, thanks so much for joining us.
Oh, Steve, always. Hey, man, we've connected so long time, and I'm glad we can finally do this, man. Nice to be on the Small Cap Steve show.
Well, look, lots to talk about. Something I enjoy talking about with you is that I know you actively manage an ETF along with Scott, and you've got a lot of thoughts that we can get into in some of these holdings that are exciting names to talk about. Yeah. But we're both coming off of PDAC week.
That's right.
And right now we've just been talking about the juniors. I'm sure you must have had 50 conversations over the last 4 days of what's the problem with Canadian junior mining. We got groups like Save Canadian Mining out there that, you know, they want to get rid of the downtick short or put in an uptick rule. Yeah. I've seen some other theories out there. A lot of people also say, well, hey, there's just not good enough operators in the Canadian junior markets, and that's why nobody's investing. And on the same token, we're not seeing a lot of mines go into production in Canada or even around the world for that matter. Yeah. What do you think's happening in the Canadian small cap market?
Yeah, so like I think there's a lot of postulations out there, and I know one of the ideas thrown out is just get pension funds more involved, like more directly invested, and I think that has some pros and cons to it. I genuinely think that at a high level, it's better to help foster mining, on the ground, as opposed to dictating, where pension fund assets go. Like, I think that's going to be a harder rock to push because you've like it kind of one has to follow the other. And so basically, we have to really, I think the force here is just, if we can continue, and this is all Canadian specific, juniors obviously mine all over the world, but I think obviously it's one of those issues where there's a lot of frustration, but I think it really comes down to the commodities working first, right? And so once we get a good leg with the commodities, now I know gold is a separate situation, but I think the commodity leading first, and I think I'm just thinking the battery metal spectrum, right? You get that going, and then the next leg is just there will be an opportunity, and so we've written about it around uranium juniors relative to the chemicals, and we've looked at past cycles, and the fact that historically the juniors always have leverage, right? Like if you're gonna get a major going up X, the juniors typically go up 1.5, 2 times X. So the other question is, do we not have active managers anymore? And that I think is actually a genuine issue. I don't know if you saw what happened with the silver junior miners ETF, SLVJ. Did you see that thing that happened a little while ago?
Yeah, that was about 6 weeks ago. A bunch of them kind of ripped on, it might have been like a Friday afternoon, and a whole bunch of silver names were either up bigly or down bigly.
Yeah, look, I actually think if you kind of go to the core of that actually is it's a microcosm of the big problem, which it really, this thing had 700 million in US assets, and the silver junior market, like that, that kind of flows moving around in one day at the close. And what ended up happening is Amplified bought the ETF, totally and this is just to match an index that was given to them, with no regard to what's going to happen to these securities, right? And they're like, okay, we're going to switch to this new index. So you get on one side, all these securities gapping up, say 30, 40%. And on the other side, you have all these securities gapping down 30, 40%. Now, this is not a victimless crime, actually, Steve. It actually, there's a fundamental victim here, and that's the unit holder of that ETF. Because you've got this indiscriminate index following ETF that actually is the largest silver junior miners fund, full stop, that it has no brain, right? So they literally just do this for me on market on close. I don't care about the price implications, but there is, like, clearly you've overpaid 30% for some names and sold at 30% losses for others. So the real question is like, those kind of events should really highlight the opportunity for active management to make a comeback. And I think I'll probably focus on that because I think, Steve, in juniors and mining in general, I think we're almost like this brainless entity. And I'm talking about when you look at assets under management, you're just looking at these massive ETFs that are supposedly representing their respective asset classes, but you have managers who have no idea about the sectors or mining, and B, they don't really care. These are just asset gathering vehicles. And I think that pendulum, particularly as it relates to the commodity sector, surely will start to swing the other way. And I don't think there is no sector where it's more apparent that this is happening than mining, without a doubt.
So, speaking of ETFs, I know you guys have an ETF D.A.R.P,
Yes.
disruption at a reasonable price. Did you guys come up with that, or was that a?
Yeah, Scott, I got to give full credit to Scott. So we launched the Grizzle Growth ETF, and we're talking about, like, we're always about valuation focused, right? And Scott was like, disruption at a reasonable price. We're like, okay, yeah, let's go with that. It was so good that so the ticker now is D.A.R.P, but we started with the ticker was GRZZ, and then we partnered with Meb Faber from Cambria, and he was like, we were telling him, like, hey, listen, this is D.A.R.P. He's like, the ticker D.A.R.P, and he's like, sees that it's still open. He takes it right away, and the rest is history, so to speak. So we changed the ticker from GRZZ to D.A.R.P, disruption at a reasonable price. And I actually very like, it really does focus on what we do. Yeah, and we believe that yes, disruption is the next leg of investing, and as information moves at warp speed, I think that's just the natural extension, right? But you can't be agnostic to price, and I think that's truly what differentiates D.A.R.P from, say, an ARC, right? Kathy Wood's ARC, it's disruption at any price. D.A.P.
Yeah. So you brought up Kathy Wood.
Yeah.
I recall listening to a podcast she was on maybe 3 years ago, and she was saying that when she actually first started ARC, multiple people told her, you're going to fail at this. Actively managed ETFs are not going to be a thing. And then I don't know if her success is largely attributed to just being a cheerleader of Tesla. She seems to me, from my view, like a great marketer.
Yeah.
What do you think has led to her success?
Yeah, and so we have a lot of compare and contrast differences to her, and why we feel that our strategy, disruption at a reasonable price, is better than hers. Which, if you look at the metrics, it's clearly she's agnostic to price, or she's trying to seek out disruption at any price. But I will give her this, Steve, and I will give her full credit to this. She has conviction, and she brought back stock picking and active management. As a way to add alpha. And I think that is truly something very exciting that she ushered in, no question. And so I think we can give a lot of credit to ARC for doing that, because if you think about the step before, which is really what mining is marred in right now, is just give me factor exposure, give me value, and own hundreds of names, right? And she's like, no, listen, I'll own a very concentrated, small number of names that we have conviction in. Same sort of thing. So you've had this era prior to her, and I'm talking about ETFs or funds. So, because obviously ETFs are the revolution in asset management. But if you just look at ETFs, factor-based ETFs were basically eating everyone's lunch, but charging really high fees at the same time. So you're getting a quant-styled manager just saying, okay, listen, I'm just going to give you this factor exposure, right? More or less. And so that kind of, if you look at a lot of the ETFs, particularly when you look at when you look at sector specific or styles, you'll get them. They're owning hundreds of names. You're not getting real concentration in stock picking.
When you guys are looking at positions, let's talk about the stock picking side to what you guys do. What's the criteria? What's the evaluation process look like for, say, taking a position, and let's just say that there's some new tech company that IPOs, maybe take Reddit, for example. You guys sit down and you guys evaluate it. What's the kind of thought process that goes into adding positions or taking away from positions?
Yeah. So for us, a big one is just, okay, is this, with respect to the company and the sector that they're in, is this a structurally high growth industry, right? That's your first funnel, right? And we got to genuinely believe that this is not some flash in the pan, and it really, has structural legs, right? And so for us, our focused area, time code, if you will, is in that 4 to 6 year period. Now, if it's sooner, the better, right? So we believe in the world of disruption, if we can find a company in a sector where they have genuine cash flow inflection in the 4 to 6 year period, I think that's a very exciting, opportunity. Again, this is a very different construct to value investing, right? And I think that's where a lot of investors really have a hard time, trying to think about it, because you do have to make assumptions. You have to, put yourself out there and say, I think this can work, and you're going to get some things wrong too. But the goal is that this 4 to 6 year period is what the market is rewarding in a material way, right? And like, one thing we've done is just talk about the historical timeline, right? When you think about the origins of great alpha generation in investing, first it was Graham, right? Benjamin Graham. You're basically buying assets for a fraction of their book value, and that is just, and why were these opportunities available? Because of information. I would say for a large part because of the dissemination of information, right? And as that changed, then you get the Warren Buffett, Charlie Munger era, where Charlie Munger had a huge influence on Warren Buffett to say, listen, it's you just don't have to always look for at a good price. If you find, at these deep valuation discounts, if you can find a good business at a, or great business at a good price, and I think that was his, the evolution there, that's just as exciting, right? And that's the next leg. And then you get into the world of GARP, growth at a reasonable price. And now you're saying, hey, listen, look at 1 or 2 years forward PE, start to think forward a bit, right? And we think that the evolution of GARP now is DARP, which is disruption at a reasonable price.
There's a lot of areas we could go here. I don't know if this is the doomer in me, but I look at a lot of the names that you guys are long in your top 10 holdings, and I just think about how much damage they're going to do to the global economy, in the sense that that's what disruption often does, is it comes along and it does things way more efficiently, that it disrupts industries and people lose jobs. AI is obviously something that's going to screw up a lot of industries. I think about lawyers who do subdocs, and they'll charge you for 100 hours of work to do a subdoc that they now can do with a simple tool on Microsoft Word. And maybe that might not initially happen, but there's going to be lawyers who come along and they end up taking advantage of that and doing the work for 1/10 the price of everybody else. That's in presto. That's just an example. And then we got Airbnb. I think Airbnb's done tremendous damage to a lot of economies and real estate markets. What's and I know you're in Canada. It's a very common theme here, just talking about the Canadian economy and the future that young people have. Just to sort of maybe steer the conversation there a little bit. What's your outlook on Canada over the relatively near to medium term with what the economy is looking like?
Yeah, so clearly it's a challenge space right now. I wish we would have more. When I think about I wish we'd have more tech, like just as a as a part of our overall economy, right? So that I hope can continue to grow. But B, I've never seen a resource of an endowed country like Canada screw up materially in what perhaps one of the greatest commodity markets, right? We could have been a global player in LNG, like, and all of these stumbles that I just think we have to fix going forward. And there's that, to me, is like the clearest opportunity is that we can be a massive player here. And I think, particularly on the battery metal side, natural gas is definitely not over, but you can't miss 2 rounds of it. Like, it just, like, it would boggle the mind, right? And we're still a big player in oil, right? So I still think we can be a huge player in commodities of the future. And the nice thing about that, Steve, is a lot of those, commodities are still very much, a business where people are needed, right? You can't just, couple clicks away, right? It's so there still really is a lot of jobs underneath that. So I think that's exciting. And then, we continue to grow from a tech side, right? I think those 2 pillars are what we have to encourage. No question.
And you kind of brought it up, and I know that there's it feels like, from my vantage point, and I talk to a lot of people who are writing checks into small deals in Canada, but it feels to me like there's not a lot of entrepreneurship or tech startups in Canada. I know, we hear of the odd one that's not too far from your neighborhood. I think it's FreshBooks.
FreshBooks, yeah. I walk by there a lot.
So we see the odd one, but it does kind of feel like there aren't a lot of opportunities for young people who want to work in the tech world. And the people I know that sort of are in that space, they're often looking to go work in the States. Do you get that sense as well?
Well, yeah, we have a challenge, right? So when you think about other tech ecosystems that are developed, right, they don't have this sucking sound that America has. And literally you're not, and I went to Waterloo, and, a lot of my friends were in computer engineering at the time. And it's just like, that sucking sound has been there forever, right? And it's one of those that, we'll always deal with. But at the same time, I think we, like, specific Toronto's a great city. I think we can continue to encourage tech companies to come here. Make no mistake, we're still, we still have a highly educated workforce with a dollar that seems to continue to go down relative to the US. So I think there are some natural benefits here. Like, I think that opportunity could be, could really present itself. Now, I know, like, I do know some friends in the tech ecosystem. Clearly the missing piece that the US has is the VC component, right? Like, that's a huge it's a huge generator of jobs and that ecosystem. But I don't think, by any means we're out of it. I think we're banging well under our weight for sure there. Right. I think we can continue to build that out. Like, look at Shopify, right? Like, that's an incredible story.
Now, I know you were on Cannabis in the early days. I'm not sure if you're still actively following Cannabis. I know that there's still a community on Twitter. I don't really pay too much attention to it, but occasionally it just shows up. And my viewpoint was, I knew that it wasn't going to work out as well as all the sell side bankers wanted us to believe. Yeah. But it's actually been so much worse than I think even most bears expected. At least in Canada, I know that there's some companies that are you make money on an adjusted EBITDA basis, whatever that means. Yeah. But what's your take on Cannabis? You think that there's a long-term bullish thesis there, or do you think it's just a space where retail investors maybe just got a little bit carried away?
Yeah, and obviously, like, there was that, and again, Cannabis was a disruptive hope, right? That you have this opportunity to really become, like, and I think when everyone thought about, okay, well, what's the absolute upside here, is you become the next beer company, like iconic beer company or tobacco company in its own, in its own category. What has yet to be shown is that there is any sort of one company that is defining all that. and margins have been brutal, right? And so that's like, at least that's a part of the Canadian example. Then when you look to the US side, which, you know, we're spending, you know, we spent more time following closely. Again, that's just been a very challenged space where you can't, my hope is that it really does work out for everyone. You know, I'm not bearish to the point of like, hey, listen, the whole thing is like a short, but I think that in, you know, like we're just not in the space, but I think it's really hard given the US political landscape to mount change where you get both sides, you know, pushing it forward. Right. And I think that's the harder part. And I think Biden had an opportunity. I do believe, you know, when he had more votes, and I think that's passed. And just, it's, when I look at some of, let's call it what it is, right? Some of the backward nature of American policies, particularly as it relates to war on drugs, et cetera. Like, these are issues that I don't think just kind of like you have one side advocating for this, but you have a very vocal side. I think that's like, Steve, that's the biggest difference in America culturally to Canada, right? We never had conservative, like we never had roadblocks to say, no. Like, you know, they were like, obviously it was Trudeau that brought it all through, but it wasn't like a cultural divide, if you will.
Yeah, it feels like it's going to get through when there's major legislation passed. It's going to be when the Republicans are in power, just because the Democrats probably are just going to get out of the way and let it happen.
Yeah. And listen, see, like, you know, it just may take more guys like Mitch McConnell leaving. You know, it's slow, and you just kind of need all these kind of old guys to just go away, man. And that really is kind of what it comes down to. But yeah, like, you know, and that from our perspective, there are multiple sectors like cannabis that, you know, you think, okay, listen, this could be an opportunity. And so when we launched the DARP ETF, you know, you have, the only way you can really invest in these things in it as a US listed ETF is to buy through the swaps. And, you know, it's a process, Steve. Like, it's just a process, right? And so for us, it's just like, we'd rather not.
I know you're kind of looking at all stuff. I got to ask you about gold. What's your thoughts on gold? Do you think that there's still a reason to be hopeful if you like to invest in those early stage companies? I was talking to you before the interview about how there's certain names out there that, in my view, have had discoveries. They have cash on the balance sheet. They've got, you know, $10 to $50 million of historic drilling, and they're trading at like a fraction of that. You know, enterprise values like south of $15 million, say, with a discovery, cash on the balance sheet, and having spent $40 million drilling. There's a few names like that. You think that there's that now's the time to be looking at those names, or do you think that something big and ugly is going to have to happen to the global economy for gold to actually end up having some sort of a significant rip?
Yeah. So, you know, kind of just walking through the waterfall here. I you know, first of all, are we bullish gold? I think absolutely, right? Like that, I think is, and you know, we're bullish Bitcoin as well, and we put out a piece just before you know, just before the launch of all the Bitcoin ETFs, saying, listen, like, there's going to be an incredible amount of capital that will flow into these things, and you know, that will continue to drive it. And one thing, I was at the you know, I'll just kind of paint the picture macro wise, right? I think this is because both do relate, right? I think one thing that I saw that was pretty incredible, right? That I was at the ETF conference in Miami, like the largest ETF conference, and I'd never seen anything like this, Steve. Like just the full court press on you've got, you know, 8 Bitcoin ETFs, all just pushing out there, talking about store of wealth. There's never been a almost marketing blitz to talk about, you know, the other side of what the Fed's doing, right? Like it's just kind of, yeah. And the reason being is, why would Fidelity do it when there's one ETF, GLD, that owns the liquidity in gold, right? They're not going to benefit by talking up gold because there's nowhere else to put that money in a physical sense. So with Bitcoin now, you have multiple players now, all several of them multi billions, that now can say, hey, listen, put it in ours, put it in there. It's all, this store of wealth. But I think what's happening, because gold is obviously still performing strong, and everyone's wondering, well, listen, the GLD flows have been going the other way relative to gold, but it kind of really focuses you up that basically GLD is like nothing in the spectrum of the broad gold market relative to, say, these Bitcoin ETFs to a much smaller market in Bitcoin. But that all being said, we continue to believe that this, the broader setup for us is central banks, G7 central banks are all cornered. They're not going to be able to get out of this without continuing to keep easy monetary policy. And that will continue to be a tailwind for gold and Bitcoin. But the gold side of it is very real in the sense that other central banks, non-G7 central banks, China, India, the emerging markets will continue to be net buyers of physical gold, and I think that's really what's happened. So we think that backdrop. So both markets can work, but in that backdrop, we will definitively get a very exciting market for gold miners. Now, why would I not want to own a senior miner relative to a junior or mid-tier miner that is long resources? Is for the fact that you look at any senior miner and their inability to grow production per share. And that's been one challenge that these mining companies have always faced, particularly in gold, right? And so I think by definition, as we start to see the opportunities for gold miners, led by the price of gold, you're gonna get money coming back in. Now, yes, there are orphan companies, etc. Where's the money going to go first? Well, it's going to go with the names that actually have gotten funding already, right? So there is going to be a concentration, but I think that will then, the breadth will then broaden out from there. But again, like, that's not dissimilar to a lot of other subsectors in mining as well. But I think one real tailwind you have in gold that you don't necessarily in all the other metals is you really do have a structural strong price that I think will then work its way through to the juniors.
Asking a question here about ETFs. What's the general rule for ETFs? I know that there's like thousands and thousands of ETFs, and you mentioned you were at a conference for one.
Yeah.
How large of asset management does an ETF typically need to get to the point where it's sort of self-sustaining? Is it number like 50 million? Is it?
Yeah. So, and again, these economics differ a lot because it depends on what you're charging MER-wise. Like, is it active? Is it passive? Is it, so there's a whole host of things where I can't just give you a straight, that's what it is for every ETF. But for the most part, you do need to get over that 25 million threshold. But again, that's coming down, right? Like that, and realistically, right? Like that could be more for some, could be less for others, but I'm just giving you a broad kind of, broad ruler there. Right. And I think like that's really what's enabled so many strategies to come on, is that, listen, if you've got a real strategy that's differentiated, the performance is working, that's a real opportunity, right? And that for us is, it's what's enabled, DARP to get onto the board.
What do you think is more important with running an ETF, marketing or returns?
Yeah. Oh, so this is what I always say: without returns, you have nothing. You really have nothing, okay. Right? So, it's marketing matters to, if you're doing some sort of like buzzy, thematic. And I think we're over that. Like, look at there was a last bunch, and I don't want to name them, but like all of these like really esoteric buzzy things that I don't think will get to the size necessary to grow. And it's just kind of trying to capture some like quick little buzz. And the super buzzy ETFs, I genuinely believe, if you buy them on that buzz, for whatever theme that is, typically, and I want to say in all cases, you're buying at the top, right?
It's
yeah, sorry, typically like, they come out like they're the one and all this money flows in and, just like, and the same thing really, like, when you think about ARK, the time to, and now she's been running that for longer, but like, when she really got buzzy, that was like all of the weight of assets came in right at the top. I think that there are a lot of guys who do like good work on how much capital is destroyed, but that's not her. Like that's literally when the assets flow, right? It's if you'd gotten in several years earlier, right? You're probably, you're definitely not as bad as where the weight of money sat.
Kathy Woods, she's absolutely unapologetic. She's shameless about her predictions of where the world's heading. And she says it with so much conviction that every time I see her on TV, I was just like, oh, she's right. That's just going to happen.
Yeah.
Like I started thinking about it the next day. I'm like, that doesn't make any sense.
Well, I put out a tweet a little while ago that kind of did numbers there, but I just said it was kind of remarkable. So we've got over 33% of our like it's in every day it's clicking higher in semiconductors. She's got no weight in semiconductors, none. Right, and that to me is wild. She literally, so the most disruptive ETF. She presents herself as the leaders of disruption who missed the entire AI disruptive trend. I think that's wild.
Yeah, it's
it's and I like and that's just that's one area like what it's interesting is that and I think genuinely like this is the exciting part of running an active concentrated ETF is that we really can put up performance and numbers that are very differentiated to these other ETFs. Now I'm not talking Kathy, I'm talking like this AI, this thematic, and you just know they own hundreds of stocks. Like it's not going to perform as well as owning focused names in AI for sure.
So obviously I'm a small cap penny stock degenerate gambler. Do you think that we'll see some of the AI capital trickle down to the smaller names? So far we haven't seen it. I thought if you asked me a year ago, I would have said it's around the corner. Obviously we're dealing with a really aggressive interest rate environment, but so far, like we're not, you see a lot of companies are adding AI to their name thinking, okay, that's going to work. Yeah. Like it used to work back in the day with cannabis stocks or uranium or whatever. It doesn't seem to be working.
No, I don't think that, and that's one of the challenges, right? Typically you'll see this kind of like envelope, big ideas, dreams, and that just like you'll get better returns from these small cap names, or micro cap just because they're caught in the theme, right? And that's where AI is so different because it really is a big player's game, right? Where capital is literally the mode of them all, right? And look at like if you look at the OpenAI video. That all of that video stuff that was going ballistic. If you think about what happened there, it's incredible. So you go from a world of Will Smith eating spaghetti, hand going through his face, like just kind of like not the greatest video AI, to now you have things that people are just sending a quick tweet to Altman, and in an hour they've got like a CGI episode, like at least a minute of that, and that. But behind that, Steve, how many non-public startups got buried that day in video AI?
Yeah,
countless. And so it all comes down to compute, right? And so like it almost is the other world where when crazy things happen, you're like, wait a minute, it's just this big fish that's owning that entire vertical, and it just keeps getting bigger. And now these little guys are like, there's not even the opportunity for them to get eaten by OpenAI. He just got defeated in a day.
Yeah, that's very fascinating from a portfolio management perspective. Like it almost kind of feels like a big part of the reason why there's so much money going into Nvidia is because nobody else really knows how to play AI.
Well, yeah, like and you kind of go. There really aren't any other real genuine ways to play it. Like you can think of, okay, well, listen, Adobe's going to incorporate it into their system, and now Adobe is an open AI play. I genuinely believe Microsoft is, because ChatGPT, right? That's real. But like, and Adobe, like, I was talking to our creatives, and they are incorporating more AI, but it's a stretch to believe that they don't get disrupted along the way, because their market is definitely open to getting disrupted, right? So we've tried and we've looked pretty extensively, and I'm talking, there may be some small auxiliary plays, but the valuations are probably way ahead of themselves, and we don't think the valuations are that stretched at all. And that stretch is like, we just think they're not challenging for NVIDIA. So why not own a lot of it?
I have to ask you, we're talking about OpenAI here and Microsoft. I don't know if you saw the article today that came, or might have been yesterday, that came out that Elon, who originally was Mr. It's altruism. This is for the good of mankind. We have to properly do AI. Turned out he was trying to merge OpenAI into Tesla. Now, I noticed that Tesla is not in your top 10 holdings. What are your thoughts on Tesla?
Yeah, so I had just a tweet today on it, but a lot of our competitors in disruption have Tesla at like very large weightings. Like, I know the Meet Kevin of YouTube fame, I think he's got like 16%, and something. It was higher. The market took him lower, but I think like just the classic. It's Elon, it's disruption, it's the future. That kind of word association. And off you go. If disruption has a bull market, of course Tesla will work, right? Like, that was the conventional wisdom, Steve. And now this is why we believe we've genuinely entered a stock picking market. Is Tesla is actually nowhere to be found, because the market has sussed out very quickly that basically there is, like, the next leg of innovation and disruption is going to come from AI, and Tesla, in the small vertical of self-driving cars, and I'm not going to get into that whole thing, but in the bigger Elon Musk Inc. enterprise, he's short, like, he has no AI functionality to speak of, right? And Grok, like, classic Grok. I know Vinod Khosla is they're going back and forth, but the bottom line is, it's Elon's coming across as facetious, right? Like, all of this, humanity, this, that, the other. The reality is that you've missed this next big bull run, potentially one of the biggest in disruption, which is what your company has been known for, innovation and disruption, and you don't have a piece of that. So one thing we did historically, I thought was really interesting. We looked at the premium price to sales of Tesla to the NASDAQ 100, right? So typically, when Tesla's priced above the price of sales of the NASDAQ 100, that premium, you can think of it as like an innovation premium, right? The market's willing to give Elon, the benefit of the doubt. Like, he's going to pull another rabbit out of the hat. Like, he's done things like rockets to space. You really developed the whole, electric vehicle sector. So so you have this premium, right? But historically, when the stock goes through, the price of sales goes through the price of sales of the NASDAQ 100. The last time it happened, NASDAQ basically fell 50% from that point. And right now they're basically touching, like, we're like 10% away. So I think that's a real great sign. So, like, then what happens when the price of sales becomes the same? Well, actually the profitability of Tesla and the NASDAQ 100 are actually very, very different, right? You're talking about the NASDAQ 100 trading on a forward 12-month earnings on 27 times versus Tesla trading on 54 times price to earnings. So it's almost like you don't care about price to earnings as long as you kind of have an image that, innovation can happen. But as soon as the market comes to realization, well, wait a minute, has this stock gone X innovation? Now I got to look at, like, the underlying cash flow, the underlying earnings. And that's when things don't get so pretty. We have a small position in Tesla, just in case we're completely wrong. We're not going to totally excellent, but by no means is it our top 10 name. We definitely don't own it in size and weight like a Meet Kevin or whatever, right? It's or a Kathy, right? Kathy, it's her second largest holding.
Interesting. So just to sort of summarize that, you've got this sort of metric. You're looking at the price to sales of the NASDAQ 100. You're comparing it to Tesla's, and you've got sort of this level where you're saying if it gets up above there, then it's time to go short Tesla. I don't know if you're short. You're probably not shorting it, but
no.
And conversely, you're buying it if it goes below.
Yeah, we're never really so since we started to run the fund, we've never really gone structurally long the name. So it kind of that's never been we all held it, right? We actually didn't hold it, and we're like, okay, listen, it got cheap enough. We thought we'll just kind of own a little bit, but we've never owned it in the size of our competitor disruptive funds. But I think just the way to think about it is the price of sales is like kind of. It tells you if it's trading at a premium, that means to the NASDAQ 100, that means there's an innovation premium built in. So if your price of sales is higher, that means that, listen, this stock could work, or the market's at least giving it credence to that, right? And but then the other side of that is that once the price to sales goes below that of the NASDAQ 100, well, then the market is skittish about their innovation and disruptive potential in the future. And that typically, that crossover of the price of sales going lower has been a trigger for the stock to sell off materially. Now, there comes a point. Now, again, historically, Elon has always pulled another rabbit out of the hat or just, kind of kept the story going forward. But, typically it hasn't been a good place to own Tesla as that price to sales comes down towards that of the NASDAQ 100.
So Thomas, I could talk to you all day, but we're running out of time here. One question for you. I know you're a foodie. I followed on Twitter. Who's got the best pizza in Toronto?
Oh, pizza's tough, man. There's so many good spots. Pizza's a tough one. I actually, I go to you know what? A pizza's one that I can't, it's actually a tough one for me because there's so many and there's so many different styles. That's a hard one. But I will say this, the best Indian actually is just down the street from me, Dilsey. That actually was it was a really, really good. I really enjoyed that. And so, if I had to say Matachione, which is on DuPont, they do an incredible pizza. But to be honest, Steve, that's just literally proximity. I walk there and I eat a pizza and I walk by FreshBooks to go there. So
My favorite pizza place in Toronto was, do you remember the Big Slice that used to be at, I think it was Yonge and College?
Oh, and
there was always techno music playing and a Rastafarian guy slinging pies. It was the best. Yeah. And of course, it's like everything in Toronto now, it's going to be a condo and it doesn't exist anymore.
Man, speaking of pizza, right, and just give you a little thing, I kind of had an epiphany, right? Toronto, we have obviously a very large Italian Canadian community in Toronto. But speaking of innovation, it's curious that the Torontonian Italian community had never created a pizza pie that rivaled the great American pies, like in Detroit. Like literally, you can go through the major metropolis areas and you have a defined pizza pie that is functionally very different than what you get in Italy. And literally the only reason the renaissance in pizza in Toronto is actually nothing to do with a pizza that we invented. It actually is just because we're really doing like Italian pizza back better. Just doing it, Naples pizza better, right? But we just haven't I always had a question why? Why is that the case?
Yeah, it feels like Toronto has it has a lack of mom and pop pizza joints. Like I know that there's some, but it's like once somebody has success in the pizza game, they're like, oh, let's put 50 of these across Ontario, and right. Then it kind of loses its charm and it's no longer cool to talk about.
No, yeah, I think pizza's done more to destroy culture in Toronto than any other institution.
Well, Thomas, thanks so much for hopping on here today. The ticker symbol for the ETF is DARP, Disruption at a Reasonable Price. I congratulate you guys on all the success you're having with the ETF. I look forward to seeing how you guys do in the coming quarters, and hopefully you'll keep coming back on here and giving us your thoughts on the market.
Oh, Steve, thank you so much, man. And yeah, always a pleasure to chop it up. And I'll have more pizza recommendations next time.
Thanks, Thomas.
All right. Thanks a lot, Steve.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section. Thanks, everyone.